Hello and welcome back to another episode of the Retire While You Work podcast. I am Carson. Alongside me, I've got David, Myles, and Jeri. Jeri, thank you for joining us today. A little bit about ourselves. I'm Carson, wealth advisor here. Myles, also a wealth advisor here at Adams Wealth Partners. David Adams, hence Adams Wealth Partners, founder, CEO for right at 20 years, coming up on the big 2-0.
Yes, sir. Thanks for that, Carson.
Then Jeri, our director of operations, been here 6 years, industry 20,
30.
30?
30-ish.
Okay.
Come on.
Sorry.
Set those numbers up.
Say that to say, seen a few things, seen the ups and downs of the stock market. So I feel like a good topic as a stock market during recording of today's episode is making all-time highs, though we know it's not always making all-time highs. And I think if there's anything we've learned over providing advice and talking with clients over time, it's that most of what we do is not revolved around numbers and returns. A lot of what we do is specifically revolved around financial planning and emotions and the psychology of investing. So I think, David, as the founder, leader of our business, why don't you go back and explain, in your experience, the impact that emotions play on investing and just your history with emotions and dealing with the ups and downs of the stock market.
I mean, I would start by just saying that emotions really are an behavioral finance of investors. It's really everything when it comes to financial planning. If not, then everybody would, and the argument would be you could just do it yourself, have a robo advisor, throw all your money in one investment and just never look at it again. And in theory, you would be okay. But we all have emotions, and not only do we all have emotions, two emotions, fear and greed, are the biggest killers of returns and lack of success in financial plannings. And so it's our job and we can dig more into that, but it's our job as wealth managers to set beside clients and during those times. Like, so for example, right now you mentioned the market may or may not be hitting close to all-time highs. That's usually when people feel a little bit more euphoric, maybe feel a little bit better. They see their balance sheet, their 401k, their investments are at a new high. They feel a little bit wealthier. And then fast forward 4 months, hopefully not, but you could see the market, down 20%. And then all of a sudden the feelings of scarcity and fear come into play, and that kind of changes everything. And the human nature would be, oh my gosh, I need to call David, Myles, Carson, and Jeri, and maybe we need to put some money out of the market into cash and go more safe, if you will. So, obviously I've seen that through all the different, through 2007 and 8, through 2022, and now, and just different times along the last 20 years. And there's a reason why there's studies, and I won't quote this exactly right. And for compliance, I'm just going to give a generic kind of input as far as this goes, but like the average investor, let's say over the last 50 years, do-it-yourself investors maybe average 2, 3, 4%, and maybe the market on its own is maybe, let's just say generically 10%. Why has the average investor performed so much worse? And that's because of timing and getting, fear and greed, putting more money in when things are good right before the market turned down, or right when things got really bad, they pulled the money out of the market only to miss the next 6 months where the market returned, 20%. So I've seen that over and over and over again. So
yeah,
it's funny hearing David. Have y'all seen when people are so afraid and the market's down and they've already, they're down, and then they insist on taking their money out anyway?
Yes, I will say the majority of our clients, because hopefully good coaching, and they've been with us for a while, and they've been to our seminars and read the book, and they kind of know our philosophy. They tend to be better than maybe somebody without guidance, doing it themselves, just sitting at work, watching their 401k lose $100,000. So most of the time we send emails and we do calls and webinars and stuff to kind of help through that. But I have still, despite all of that, despite the best guidance that we know how to give, I've had, 2 or 3 over the years insist against our advice of pulling their money out of the market. And I remember there was 1 or 2 that did it, and it cost them. And the hardest part was not getting out of the market when things were bad. That was easy for them. It was knowing when to get back in. And so once they missed kind of that uptick and they missed then they were like, well, gosh, now I don't want to get in because the market, is high. I'm going to wait for it to fall again. And then maybe the market doesn't fall again. Maybe the Dow was like 14,000 in 2007, 2008, fell like to around 7,000, lost half. And so if you pulled out at 7 and then wanted to get back in at 10, you're thinking, well, I'm going to wait for it to go back to 7. Well, it never did. It went to 14, it went to 18, and now it's at what, 39, 39,000.
I just
So
got
I
a
have seen-
notification on my phone. The S&P hit an all-time high, 5,200, as we're sitting here recording this. So,
Wow.
Yeah. So there you go. So yeah, Jerry, and I'd say certainly seen it. We're seeing it. We're hearing it less now, I think, because as our clients have been with us longer, and hopefully as we become better advisors and we've gotten more experience and just better at articulating stats and history and client examples and
educating
educating
our clients.
Yeah, we do a lot of educational. It's all the things that we've done to better ourselves. I think clients are also, impacted by that. And so together we're all stronger.
yeah. And I would say, Jerry, and to your question, not necessarily people pulling out of the market and not getting back in, but I think in 2020 and 2021, during the COVID times when people were stuck at home, working from home, I feel like we had some clients who wanted to get involved in managing their own accounts, even if it was just a small percentage of their overall assets. And then you see a year in the market like 2022 when it's down and it doesn't feel as fun or as euphoric, when it seems like it's a little bit tougher. And we saw them come back to us wanting some advice on what they were doing, or just went hands off and said, hey, I'm not as good at this as I thought I was. I want you guys to take this back over and help me out here.
Yeah, I mean, COVID was a good example. Like you said, Myles, two things were going on. One, the market was just going, after it fell during March of 2020, it's the fastest drop in the history of the market and the quickest recovery. Once they saw the market coming back, they're staying at home, they're bored, they don't have a lot to do, maybe, and they're watching the market just go up, up, up. It just felt, hey, maybe I'll dabble in this and not pay somebody or just, develop a new hobby. And then, like you said, Myles, 2022 kind of took the wind out of their sails when they saw like, wow, this really isn't, this isn't easy when the market's down 20, 30%. So yeah, there's so many different examples of that over the 20 years or last 20 years. And I know there's going to be over the next 20 years. And that's kind of like one thing that just never changes and that's why I think that our industry is still around and thriving and the good advisors still thrive. And then just like any other industry, there's advisors that kind of hide under their desk, when the market's down and don't provide that counsel and maybe let their clients do what they want, pull their money out and make bad decisions. And a lot of
I know over the years with the different firms I've worked at, it's definitely over time, the more educated the client is, the less they're going to freak out, because I have worked at firms when down days have been horrible because of, like we're saying, people's emotions just get the better of them. And a big down day was like, let's do something, let's get out, that's whatever. And that's just a case of you're just not knowing your clients well, and I guess not getting the message across.
Jerry, do you think that part of that, not talking about a specific person or firm, but just part of that would have been like, the advisors and the firm themselves kind of panicking and that energy being kind of translated to
absolutely. The whole, like, your broker's going to jump out of the window thing, that was real. Yeah.
But, and even in what we do, we have emotions just as real as everybody else. Whenever I can speak to, the COVID crash, I remember that the day that I took my CFP exam, I came out and the market had dropped 12% in a single day after I got out of taking my exam. And I was like,
yeah, great career choice.
What is happening? What is happening? And had over like 100 emails when I turned my phone back on. It was absolutely wild. So, and still, I remember that time. It was, not only was it weird because of COVID and everything else, staying home, yada, yada, but it was also just like, I remember looking on my phone and looking at the stock market and truly seeing at one point a 25% drop. It ended up getting to low 30s or something. And I remember it was so just like almost like a panic. Yeah, because it's like, this is crazy. The market's dropped a third of its value has already been wiped out.
In a month.
in a month. And I think the difference is that emotions are real for absolutely everybody. Everyone has emotions when it comes to investing. Seeing real dollars be cut by a third in the matter of 30 days, yes, there's no getting around the emotions that we feel as human beings when something like that happens. But what I think the difference is, and what makes great investors versus bad investors, is whether or not you act on those emotions. Because my tendency then is like, I remember even with looking at my account, I was like, okay, I should do something. The market's down. I feel like I should do something. What should I do? What should I do? And that's like the first tendency. But the reality is the best thing that you can do whenever it's down like that is nothing.
Or
Or add more
or
money.
add more money, which is
That's
the
right.
opposite. So learning, and that
It's so hard to do though. Like when in
It
a moment
is.
like that, I mean, we're having those conversations here, and it's just so hard to do. We
It
understand
is.
it as well.
But if you're
Mhm.
principle driven, and I go back to times like, in 2001 and 2, after the internet, the tech crash, and then 9/11 and all that, right before I started the firm, but I still had some money invested. I remember, seeing that. I'm like, oh my gosh. But then I had, a little bit of money in the market, but more money coming in. So I just invested. But then as, 2008, I'd finally built my practice, up to a pretty big number after 5 years of hustling. And then I watched half of it, kind of disappear over 8 or 9 months. And my net worth had just started building up as well. So I felt it differently, when you're getting started versus when you have money to lose. Um, and then fast forward to somebody, let's say now, if it happened when the numbers are, practice is bigger, my investments are bigger, I'm going to feel it because it's just a larger dollar amount. But the one thing that I've learned is, regardless whether somebody has $10,000 or they have, $50 million, the market falls 30%. You're down 25% or 15 or 20%, and you're feeling that, and you want to run to the sidelines. You know better than to do that. You say, no, I'm not going to do that. What am I going to do? Well, I actually have, an extra $100,000 sitting in a money market. This is actually the time for me to buy more and to invest more into my financial plan, which is the last thing I want to do. But every single time throughout history, that is proven, just whether it's 6 months later or 4 years later, it's proven to be the right move. And I've just learned to do that. But it's like no part of me, even doing this 20 years, zero part of me wants to do that when my current investment plan is way down. But I know that that is the way the best investors do it. And we know it's the right thing. And that's what we do with clients. We advise them to do that. We do it in our models when we rebalance. When things get a little frothy and we go and rebalance each year, we take some out of stocks and go back into fixed income, because we're trying to do it mechanically and robotically to remove the emotion. So the client's not saying, wait a second, I don't want to take money out of stocks right now and go into bonds. My stocks are up 15% and bonds are only up 6%. Well, if we're going to rebalance, we're going to take some gains at the height of the market and try to buy back into something more conservative. And so all those, you have to be principle driven, I guess is what I'm saying. I could have said that in 10 seconds, but I like to talk.
A little drawn out. I think it's one stat I've heard, and obviously past performance is not indicative of future results. However, if there's one thing that the market's always proven to do in history, is it has always made new all-time highs. Now, that does not mean it's going to happen in the future. Big disclosure there. However, in history, no matter how big the drawdown, still to this day, the market has always made new all-time highs. Through the Great Depression, financial crisis, tech bubble, COVID, 2022, market has still always come back. Market has still always made new
crazy elections. I mean, we could talk about that, regardless of your political affiliation. You go back to, I think clients, that are left, clients that are right. Obama comes in, Trump comes in. It's like, oh gosh, what is this going to be? Oh gosh, we need to get out of the market, or let's put more. And the reality is the market just kind of keeps ignoring that noise, and it, and it moves to all-time highs.
Yeah, I feel like we have all the charts in the world to show that investing on your political feelings or leanings is one of the worst decisions you can possibly make.
Yep. And this year is going to be no different, and it's going to feel different. I mean, you hear that, yeah, but now it's different. Yeah, but now politics are more divisive, and
This time is different.
they are, but then the result in the market is not different. It might be exaggerated, like a little bit higher highs or lower lows, but the story is still the same. And so what I tell people is, let's say you're saying, no, this is the end. If it's really the end of the economy as we know it, and the stock market's going to go down and never come back, and there's no economy at that point, like, what are you going to do with a bunch of cash under your mattress? What are you going to do if the banks shut down? At that point, it's like, you might as well just have bottled water and, food or whatever, say like you can't live in total fear. And if you bet against the history of the stock market, which the odds are totally, against you to bet, to play the contrarian theory, you're more than likely going to be wrong and it's going to cost you. And then if you're right, finally, it's going to be when there's no economy anyway. And then who really cares, right? So I look at it just, a little simplistic like that and just say, why bet against the momentum and the history of the market? Let's stay principle driven. Let's hire a coach, which would be us, just like you do in anything else. You have a doctor.
Control what you can control.
Yeah. You have a trainer, you have a doctor, you have people that you pay, or, you can do it yourself. And if you do it yourself, you just need to be sure that you feel that you don't need the accountability. And when times get hard, that you're going to press through it. So,
and I think that's maybe one
ahead.
reason why our clients feel good about working with us is because they feel like they have a plan in place, not like when the market's down or even when it's up, they know that we're looking at things and watching out for them, and that in general, they have a plan in place that's going to help them succeed from the financial perspective.
I think that's true of anything in life, just having a plan and then having a team, somebody around you. I mean, I'm a CPA, Carson's a CPA. I'm trained to do my taxes. I could do my taxes, but from a time perspective, I don't, because we're helping clients do their stuff and watching the market and that sort of thing. But I have a team. I have 2 people that help with my accounting, bill pay, bookkeeping, taxes, and I know enough to be dangerous to sit in a meeting with them and say, all right, team, what can I do different? Is there a way? Is there something I'm missing? How can I pay less taxes, or am I doing all the things that are ethical and above board that I need to be doing? And when they're going through and walking me through that, I get the peace of mind, and then I'm not stressed about taxes. If it was all on me and, I'm behind on client work and then I neglect my own taxes, kind of the doctor's kids are the sickest philosophy, then I'm going to be stressed about taxes because I'm doubting myself. Like, I don't know if I'm getting everything. So just having people that you pay, that you trust to do these things will make your financial journey more than likely, and most of the time, that much better and more profitable.
That's good. I think, lastly, as we close, in one sentence, what is your one piece of advice on handling your emotions when it comes to the stock market from each of us?
Oh,
I would say, as I have the news on here behind me, it would be to turn off the news.
That's good.
I would say, even though I'm in this industry, don't look at your statements. Kidding.
Yeah, that's true though. A lot of truth.
Yeah.
There.
Don't look at your statements every month.
Yes.
Sure.
Yeah.
Carson?
I would say, be aware of your emotions. Don't act on your emotions.
It's a good one.
And I would
David?
say, have a team. Doesn't have to be us. Somebody like us, somebody that will have these conversations with you and validate your fear and say, hey, I understand. Here's what we're doing to combat that. And here are your options. You can pull your money out, but it'll cost you this. You can stay exactly the same, and we think that's the best. But what we like to do then is say, but here's another alternative. Maybe we just make a small change so you feel a little bit better. But if you're wrong, it doesn't totally upset the plan or disrupt the plan. And a lot of times just having somebody giving you options, walking you through it, you end up making a better decision, is what I've found for myself and through hundreds of clients over 20 years.
Was that one sentence?
Oh yeah. That's one sentence for me, Carson.
Perfect.
Just a long run-on sentence.
One long run-on sentence.
A lot of commas, and I didn't check
Love
the
it.
punctuation.
I think that's it. I think that's a good topic, because I think it's something that's very aware and it applies to every human being. So
Fear and greed, recognize when you have those feelings, talk to your advisory team about them, say, hey, I'm feeling XYZ, help me, and let us help. Thanks for listening to Retire While You Work. Talk to you again next week.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.